record on this computer. I'm just doing that.
Okay.
The link will be available on the commercial webinar page of the TAR website by the end of the week. Our presenter today is Rick Albers of Cooperman Orr and Albers PC. Rick is a board certified in commercial, residential, and farm and ranch real estate law. In addition to his private practice, Rick is an adjunct professor at the UT School of Law and has served as a TREC commissioner and is an active member of our TAR family. We call Rick Superman around here. He does it all. We're very grateful to have you here, Rick. Thanks. And I'm going to hand it over none too soon to you.
Great. Thank you very much, Amy, and it's a pleasure to be here as always. I do hope all of y'all forgive us for the little technical difficulty, but I'm going to try to keep us on schedule nonetheless. So I'm going to just jump right in and start talking about our topics today. We're going to, this is commercial real estate finance. We're going to have some, our major topics are going to be loan commitments, promissory notes, mortgages or deeds of trust. We're going to talk some about alternative fund sources, and then we're going to talk about when things go bad with loans and talk about foreclosure and talk a very little bit about bankruptcy. I'm not necessarily going to go through those topics in order. They're going to be scattered in and out of the presentation that I'm giving. So let's start and get a background for some common loan types. I'm going to talk about three common loan types, the first being construction loans. And construction loans are usually short-term loans. They're loans that are not funded in total. On the front end, the lender will fund the construction draws as the loan moves forward, as construction moves forward, and the contractor wants payment. Then the lender funds another draw under that loan, so the principal balance of that loan that needs to be repaid increases with each draw that's made. Permanent loans, on the other hand, are loans that are funded 100% on the front end when the loan is made, and then they're paid back over time over a much longer period. The construction loans are just for the term of construction. And once construction is finished, then that loan pretty much becomes due and payable. And at that point, when the construction loan is over, that's when you need to roll into the permanent loan to then pay off the construction loan, or you might think of it as refinancing the construction loan. Permanent loans can be for a long-term, what most people want is a 30-year loan to have a permanent loan. 25-year loans are common, even 20-year loans are common. If you get shorter term loans, then they're called mini-perms or mini-permanent loans. It's exactly like the longer term permanent loan, but the term of it may only be 10 years, might only be 5 years, maybe 15. There's some dispute as to where the dividing line is when you quit calling it a mini-perm and start calling it a permanent loan. But usually 15 years is still called a mini-perm, and 20 years is called a permanent loan. Let's talk a little bit about our lenders, our available pool of lenders. The first one that comes to mind, of course, is banks. Banks are banks make all kinds of loans, but they are about the only lender that makes construction loans. Construction loans are very heavily feed in that there are professionals that are needed during the term of the loan. The bank will send an inspector out to make sure that the work is being done, that the contractor's claim has been done, or that the borrower's claim has been done. And there are just origination fees and points up front, just like any other loan. But again, it's a short-term loan, so the percentage magnitude that you're paying, or the dollar amount, can be higher for the term of the loan. But banks also make mini-perms and permanent loans. Some banks will hold on to those loans for the full term, and some banks will sell those loans or assign those loans to somebody else, some other lender. Insurance companies, on the other hand, are great lenders for, and I'm talking about life insurance companies, they're great lenders for the long term. They don't make construction loans. They're not in it for the short term. They want to place their money for a very long time and keep it there for a long time. Insurance companies have done a great job with the mortality tables that they run their businesses off of. And some people will say that insurance companies know exactly how many people are going to die this year. And they know exactly how many people are going to die 30 years down the road. They know exactly how many of those people are women. They know exactly how many of those people are men. They just don't know them by name. They have a large pool of people, and the averages work out that they know exactly when they need that money. So they want to be able to place that money in a long-term loan and forget about it, and then have it come due way in the future when they know they need it based upon their mortality tax. Another lender that's really come up in commercial lending lately is credit unions. Much to my surprise, I've had a number of clients go to credit unions and get their commercial loans. Most of the credit unions have lower loan limits than the banks. You're not going to go to a credit union and get a $10 million loan usually. But and it depends upon the size of the credit union as well. But here in Austin, there are, I'll say, the 4 largest credit unions in town are very active in the commercial real estate lending market. And so wherever you are, if you can go to the largest credit unions in your area, you might be pleasantly surprised. They are very competitive with banks. In fact, I had lunch on Friday with a local banker, and he was lamenting to me how much competition he was getting from the credit unions. And he was crying because he was saying that the credit unions have different regulations, a different regulatory scheme, that they don't have to have the same kind of capital behind the loans. It's easier for them to make the loan. They don't have to have as much money backing it up. And the regulations are just easier for a credit union than a bank, which is one reason that I think the credit unions are starting to get into the business a little bit more. But that's a lender that you should look at. Their fees are usually a little bit less than the banks. They are, though, less negotiable on the loan documents. When you get the loan documents from the credit unions, they are pretty much cut and dry boilerplate, whereas when you're dealing with a bank or an insurance company, sometimes you can negotiate that you want a little bit longer notice period, or you don't want to have quite as large an escrow account for taxes and insurance, or you don't want to fund it with quite as much at the front end. The credit unions are pretty strict and don't allow for those kinds of negotiations. Another option for a lender is crowdfunding. And crowdfunding is changing. It's changing almost as we speak. Before yesterday, crowdfunding was available for commercial real estate finance. There are crowdfunding sites who take in money from investors and then loan that out for commercial real estate development. Before yesterday, and for those of you who may be looking at a recording of this, today is May the 17th, so yesterday was May the 16th. Before May the 16th, to fund money into one of these crowdfunding sites that makes commercial real estate loans, you had to be an accredited investor. An accredited investor under the security laws of the United States. An accredited investor is someone who has a minimum net worth of $1 million, not including their home, and expects to, and has made as a salary, or whatever their income, their annual income is, a minimum of $200,000 for each of the last 2 years. If it's a married couple, it's $300,000. So that's the way it was before yesterday. Yesterday, things changed. New regulations came into play that allows non-accredited investors to participate in crowdfunding and other capital raising in real estate loans and other fundraising sites to invest in businesses. So now, anybody can go to crowdfunding, but the amount that you can contribute to a crowdfunding site varies upon your salary. Again, it looks at what your salary has been, and there are two different thresholds that if you, I apologize, I'm forgetting what it is right now, but if it's below one amount, you have a limit of 5% of your income, and if you're above that threshold, it's a limit of 10% of your income. So it's much more available now, and we'll see how many people lose a lot of money in it by investing in the wrong things. Another source of money is the EB-5 program. EB-5 references an immigration program. Some people call this Buy Your Green Card. For foreigners who want to immigrate to the United States, this is a program where, in essence, they are able to buy a green card by investing a minimum of $1 million in the United States, and that investment must create a minimum of 10 new jobs. And there are ways to do that in real estate, and even to pool those $1 million hunks into either buy real estate or use that to loan money in real estate. If it is in a depressed area that the investor is working in, that $1 million requirement drops to $500,000. There's a maximum of 10,000 of these per year. We have hit the cap the last few years, so there's a waiting line of people wanting to come in. And if you want to take a guess as to which country is the biggest user of this, it is China. They have had about 85% of the EB-5 visas last year were given to Chinese nationals. Another program that's out there is called Property Assessed Clean Energy, or PACE for short. It is somewhat controversial. It's a government program that allows you to make energy upgrades to your properties. It's only for energy upgrades, be it solar cells or whatever it may be. You pay back that money that you borrowed through an additional tax assessment. It's a tax assessment exactly like your school taxes or your city taxes or your county taxes. And so it's controversial because taxes are a super priority lien. If you've got a normal long-term loan on your property and then you go out and get a PACE loan, that lien for the PACE loan is a super priority lien, and it comes in ahead of that first lien. So there are some issues with that. In commercial, the lender must consent to that loan being in place, for the PACE loan to be in place. Things are a little different in California, especially in the residential area, and there have been some sad stories about people trying to sell their houses who've gotten PACE loans in California, and they find out they've got to pay off this thing before they sell their house, and it has caused some people to not be able to sell their house. But the program for commercial is a little bit better than it is for residential. MREITs is another possibility, and most of y'all know what a REIT is. A REIT is R-E-I-T, Real Estate Investment Trust. An MREIT is a mortgage real estate investment trust. So if you invest in an MREIT, they normally go out and buy loans, maybe that a bank had made, on commercial real estate, and that's their sole purpose. They don't own real estate, they own loans. When getting a loan, you might want to use a loan broker. Loan brokers help you find lenders. They compare the various lenders that are out there and the available loans and give you your options and help you make a decision as to who you might want to use for a loan. They help you negotiate the loan commitment terms, and that's a very valuable thing because most borrowers don't do this every day looking for a large commercial loan. And so the loan brokers have got a lot of history, a lot of experience in what normal loan commitment terms are. And again, let me go back to the loan commitment and back to the types of loans. The most common time that you really, really want to get a loan commitment is when you're doing new construction and you have that construction loan, and then you're going to have a permanent loan later. You go, first thing that you do is you go and get the loan commitment for the permanent loan before you even start looking for the construction loan. And that's because the construction lender wants to get paid off once construction is complete. So the construction lender is saying, so where are you going to get your money to pay me off? And so you show them the loan commitment letter from the lender. The other thing that loan brokers can do is give you some support service referrals. They can help refer you to appraisers, to environmental site analysis professionals, to surveyors and appraisers, maybe even to attorneys. But they can be a good referral source for people that you will need throughout the loan process that they've worked with before that do good jobs. And actually, this next one is the one that I have found and experienced is one of the best services that loan brokers provide, and that is they help the borrower fulfill the loan commitment requirements. And so the lender wants to see all kinds of documents. Of course, they want to see the financial information for the borrower, but they want to see the leases. Or if you're refinancing an existing property, they want to see the leases. They want to see some information on the tenants. They want to see tenant estoppel letters come from those tenants, and the loan brokers can help gather and get all that information. So that's a huge service that I've seen when it's just the borrower working for that. A lot of that stuff falls off the table and it just doesn't get done as fast as it should. But then loan brokers are just like real estate brokers. They collect fees for their services. All the top part's good, but you're going to pay them for that. But if you're new to the game or you can't find a lender, especially if you're looking for a lender like an insurance company, that's almost impossible for you to go out and get yourself. You're going to need to use a loan broker, and loan brokers can be very much worth the fees that you pay them. We talked a little bit already about the loan commitment. The first thing is you make a loan application to that long-term lender. Then the lender issues a loan commitment to you. Then you negotiate. That's where your loan broker comes in or your attorney comes in, and you start negotiating what the terms of that loan commitment are, because that's what's going to say the documents that the lender wants to see before they make the loan. They're going to talk about what the quality of collateral is, what the debt service ratios may be. All the major loan terms are going to be in the loan commitment. So you need to negotiate all those terms in the commitment, not just sign the commitment blindly and think you're going to negotiate those terms in the loan later on. It's just like a letter of intent for buying a piece of property or a letter of intent to do a lease. All the major terms are hit in the loan commitment. The difference between a loan commitment and a letter of intent, though, is most letters of intent are non-binding by their terms. A loan commitment is binding, and the borrower's paying money for that loan commitment as well, so you need to get it right on the front end. Once you get it right, or how you want it, then the borrower signs the loan commitment or accepts the loan commitment, and then starts paying the fees to that lender and starts gathering the information that the lender wants to see. Let's talk a little bit about loan terms. One most important to the borrowers, of course, is interest rates. You can have a fixed interest rate, which means a flat interest rate over the entire term of the loan. You have a 30-year loan that's for 5% interest for the entire life of the loan. You might have a variable interest rate, an interest rate that changes over time. It might be tied to the bank's prime rate. It might be tied to Wall Street Journal prime, the prime rate that's stated in the Wall Street Journal every day on the money market page. It might be tied to LIBOR. LIBOR is LIBOR. That stands for London Interbank Offered Rate. And that is a very common index that's used for variable interest rate on the larger loans. You might have a variable interest rate with a ceiling and a floor. And I'm seeing quite a few of these lately, especially with loans from the credit unions. The interest rate might be Wall Street Journal Prime +1 with a floor of 5% and a ceiling of 10%. So what that means is the interest rate is going to vary somewhere between 5% and 10% over the life of the loan. And it's going to be, where is it going to be in between? It's going to be whatever the Wall Street Journal Prime +1% is. And if Wall Street Journal Prime the Wall Street Journal Prime is 3%, +1 is 4, and you got a floor of 5, well, the interest rate's 5%, not 4%. I want to talk a little bit about default interest rates. That's the second interest rate that's on the promissory note. You've got the normal interest rate that we're talking about, that we have been talking about. The default interest rate is a higher interest rate that the lender gets to charge once you're in default. If you miss a payment or otherwise in default of the loan, then the default interest rate kicks in. It might be double what the original interest rate is. It might be even higher than double. It's a negotiable point when you get your loan. In Texas, we have a usury rate, the maximum interest rate that you can legally charge. Generally, in today's market, that's 18%. It can be a little bit higher in some commercial loans, but most people just, as a rule of thumb, say, as long as you keep the interest rate below 18%, you're going to be okay with usury. So a lot of default interest rates are 18%. Sometimes the attorneys drafting the document instead will word the default interest rate to say it is the highest rate available under law, so that they can make sure they don't choose usury at the time that rate kicks in. Some lenders use a 360 to calculate risk. And when you do that, what that means is they're charging interest based on a year with 360 days. And why are they using a year with 360 days instead of 365? In theory, it is for ease of calculation, because then you can have 12 months that have a theoretical 30 days in every month. So that gives you your 360 days. But when they do a 360, 365 calculation, that means they're calculating the interest on a 360-day year, but they're charging you interest 365 days out of the year. So there's 5 additional days there that they're charging you interest on in excess of the full annual interest. So for example, if the interest rate is 10% over the year, if they use a 360, 365 calculation, those 5 extra days are going to bump the effective rate up to 10.14%. The Texas courts have said if you have a default interest rate of 18% and you use a 360, 365 calculation, you are charging usury by law. Because even if you never started charging usury, because usury is charging or contracting to charge for a too high of an interest rate. So you're contracting to charge too high of an interest rate if you're at 18% in a 360, 365 calculation. So that's why a lot of lenders will say, well, I'm only going to charge you 17% of the default rate instead of 18%, keeping under that usury limit. Payments could be interest only. Interest only could be made monthly, quarterly, annually, on any kind of periodic basis. It could be principal and interest on a level amount. We call that amortizing the loan on a level amortization, so that you pay the same amount every month over the 30-year term, and when it's amortized to the equal principal and interest amount, that means the total is the same. The amount of principal and the amount of interest changes every month, because each month you pay a little bit of principal, so the principal balance goes down. The interest that is charged at the same rate now becomes less because the principal amount is less. So with each payment, the interest amount decreases a tiny bit, and the principal amount that you're paying off increases a tiny bit. So the very first payment has a huge amount of interest and very little principal. The last payment at the end of 30 years is a whole lot of principal and just a very little bit of interest. You can have a combination of the two, of interest only and principal and interest, and that's fairly common in some commercial loans, where for the first year it may be interest only, and then after that first year is gone, once you hopefully have your tenants in, got a good income stream going, then it's principal and interest amortizing over a level amount. You might have a balloon payment. It's common to have a amortizing loan that's calculated, that the amortization is calculated over a 20-year period or a 30-year period, but the entire loan becomes due in 10 years. So that after that, when you get to that 10-year point, that's the balloon payment that you have to pay because the loan term is up. Even though the loan was amortized over a 30-year period, it balloons after 10 years and go whatever the principal balance is at that time. You also may have to, most loans have a due on sale clause, meaning if you sell the property, you have to pay the loan off. And so you have to make that prepayment, I'll call it. It could be if you sell the entire property or if you sell a part of the property. It's not at all unusual in a strip shopping center instances where you've got some out parcels or pads out in the front where a Walgreens might go or some fast food might go, that the developer sells off that one piece, and so he needs to get a release of lien on the piece that he's selling. That's a partial release, but that has to be written into the documents on the front end. There is no right in Texas to prepay. There's no right to partially prepay and release some of the property. So you've got to build into the loan documents on the front end those release provisions. Prepayment penalties. The lenders, again in Texas, you do not have a right to prepay unless it is stated in the document, because you contracted to say to the lender, I'm going to pay you 30 years worth of payments at X number of dollars per month. It doesn't say, if the loan documents don't say, and I can prepay, or I can prepay at any amount at any time, you do not have that right. You must have it written in. If you're a borrower, you usually call it a prepayment penalty. If you're a lender, they usually call them prepayment premiums, just for the negative connotation. It might be a fixed amount, which will be a percentage of the amount that's prepaid. So it might be a 2% prepayment penalty on the amount that is actually prepaid. It might be a stair step down. These are very common today, where the prepayment penalty on a 10-year loan, you have a 10-year loan and the stair step down is 5, 4, 3, 2, 1. So the first year it's a 5% prepayment penalty, the second year it's a 4%, next year it's a 3%, next year it's 2%, next year it's 1%. Be careful about what it is after that next 1%. Some lenders will say on the 5, 4, 3, 2, 1, it stays at 1 for the rest of the life of the loan. Some lenders will say it's 5, 4, 3, 2, 1, 0. So once you get past that 5th year, then there is no prepayment penalty. Watch what they say there. Yield maintenance is the one that can really bite you, and has been a number of people in today's economy, people that took out loans a number of years ago with yield maintenance clauses for the prepayment penalty. They took out a loan at 7%, and the interest rate today, if that lender was going to loan out that money, is 3%, we'll say. That's a 4% difference. Yield maintenance means the lender gets to maintain the yield that the lender contracted for under that loan. So if there are 10 years left to go on that loan, and there is a, we'll just use a smaller amount, $100,000 amount that needs to be prepaid to pay off that loan, that's the principal balance. And we've got our 4% differential, because the lender can only make 3% now on the loan interest rate's 7%. So to maintain that yield, you have to pay him 4% on that $100,000 for each of the 10 years remaining. So that's a $40,000 prepayment penalty on a $100,000 balance. And there are lots of those out there today. A lot of people are having problems selling their property because their loan payoff is so much higher than they ever thought it was going to be. Or the loan might be totally closed to prepayment. Again, if there's nothing said about being able to prepay, you can't prepay. Or it might be totally open to prepayment with no prepayment penalty and no premium. Personal liability on loans, you might have full liability, or you might have no liability at all. No liability is non-recourse, or you might have partial recourse. That's what you need to negotiate with the lender. If the lender wants full liability to start out with, tell him, no, I don't want full liability. I will pay, I'll guarantee 50% of the loan. Or my partner and I will be in this deal and we'll each guarantee 50%. Or maybe the lender will come back and say, well, the two of you, I want better coverage, so I won't make you each be 100% liable, but I'll let you be 75% liable and your partner 75% liable, so I've got 150% coverage is what they call that. That's what happens when you have single or multiple borrowers. You can do the same thing with guarantors. Guarantors can try to reduce their liability by just flat putting a cap on it, putting a dollar cap on it, putting a percentage cap of the amount that's due, or spreading that liability amongst multiple guarantors. Security for the loan, the collateral for the loan, we're dealing with real property. In Texas, our document is called a deed of trust. That is the mortgage. In Texas, the word deed of trust means mortgage. It's unfortunate that the term that we use in Texas starts with the word deed, because it is not a deed as you normally know it, and people will has a deed, and they're talking about the deed of trust. You can make the distinction a little bit easier. But that document is that the deed of trust places the lien on the property, and then that document, that deed of trust, is recorded with the county clerk to give notice to the rest of the world that you've got that lien on that piece of property. With personal property, it works a little differently. There's a security agreement and a UCC financing statement. The security agreement is the document that places the lien on the personal property. The UCC financing statement is the document that gives notice to the rest of the world that you have that lien. So that the UCC financing statement is recorded with the Secretary of State. Sometimes it's recorded with the county clerk. If the borrower defaults on the loan, then the lender wants to realize on his collateral. So how does he do that? He forecloses, is the most common thing. And what he does in foreclosure is converts the property to cash, applies the cash to the amount of the debt, and if that cash doesn't pay off the debt completely, well, then the borrower is normally liable for the deficiency, has to pay the lender the shortage, unless it's a non-recourse loan, like we talked about before. Another option is to have a deed in lieu of foreclosure instead of actually going through the foreclosure process. the lender takes a deed to the property back from the seller. That's when the lender takes the property. A lot of people talk about a foreclosure and the lender taking the property out of foreclosure. That's an incorrect statement. The lender takes the property with a deed in lieu of foreclosure. It's going to foreclosure, the lender's not taking the property. It's being sold to the highest bidder. We'll get to that. But again, as I said, the borrowers and guarantors are liable for any deficiency on any amount if the amount realized is not enough to pay off the money. So how does a foreclosure work? The foreclosure is an auction. It's an auction that's held by the trustee under the deed of trust, and it's held on the first Tuesday of the month. We have a foreclosure day, 12 foreclosure days every year in Texas. It is the first Tuesday of every month. It doesn't make any difference what else is going on that first Tuesday. It doesn't make any difference if the first Tuesday is a Saturday or a Sunday. It is still foreclosure day. It doesn't make any difference if that first Tuesday is a holiday. There's a fairly important holiday that sometimes hits the first Tuesday of each month, and that is on the 4th of July. And you go down, if the 4th of July is on a Tuesday, is the first Tuesday of the month, you go down to the courthouse and watch the foreclosures occur. Can't foreclose until after you've posted the property for at least 21 days before the day of foreclosure, and you can't post for foreclosure before you have an actual solid loan default. And again, the foreclosure sales, it's a true auction to the highest bidder. If you've never attended the foreclosure sale, I encourage you, go down to your county courthouse on the first Tuesday of the month. They're somewhat interesting to watch. That's real property. Foreclosure on personal property is a little bit different. It has to be a commercially reasonable sale. And the definition of a commercially reasonable sale is that it is conducted in conformity with reasonable commercial practices among dealers of the type of property being sold. So that's a little bit of a tough definition, but let me try to walk through it just a little bit. It allows you to sell the property in a number of different ways because it depends on what the property is. If it's stocks and bonds, you can sell those on a recognized market. You can sell those, you go to the stock market and sell the stock. And you sell it the very next day without any other kind of notice because that's what you're going to get for it. You could have an auction just like a foreclosure of real estate. If you've got a good example of that is you've got a tenant who's a restaurant and that the landlord had a UCC lien on the restaurant equipment, or maybe the bank had a UCC lien on the restaurant equipment. And so the way that they're going to realize on that collateral is to call all of the local dealers who deal in restaurant equipment, get them out there and hold an auction between them and see who's going to buy it for the highest price. Depending upon the kind of collateral, it might be a private sale. The example that's given more often than not in law school is you've got an 18-wheeler full of lettuce. And you can find somebody to buy that 18-wheeler full of lettuce today, and they'll pay you a certain price for that. But if you wait 2 weeks and try to do an auction or sell it some other way, the price of that lettuce 2 weeks from now is going to be zero. So depending upon what the collateral is, you might be able to hold a private sale. Additional kinds of collateral are assignment of rents, where the borrower, who's the landlord, allows the lender to come in and step into the borrower's shoes under the lease and collect the rents directly from the tenant once the borrower has defaulted under the loan. Might have a pledge of stocks and bonds, might have a lien on unrelated property. The borrower might not, the collateral might not be good enough for the lender, but that borrower might own some real estate in another county. And the lender say, well, if you pledge your real estate in the other county, I'll take that just as well. Promissory note is usually a negotiable instrument. The lender can sell that loan to a different lender. We talked about that before with some of the banks. And to do that, the lender endorses the promissory note just like a check. It's a negotiable instrument, just like a check is a negotiable instrument. So they flip it over and say, pay to the order of bank number 2. A lot of times they don't actually flip right on the back of the note. They attach a piece of paper with the endorsement on it. When they do that, that's called an allonge, but it's the same kind of endorsement. There are other obligations under the deed of trust. Remember, this is the lender's collateral, so he wants to be sure the collateral maintains its value. So the lender wants the borrower to keep it insured in case it burns down so it can be rebuilt, because it's not very good collateral if it's burned down. Want to be sure they pay the property taxes, that it doesn't get foreclosed on because of that super priority tax lien. Want them to keep the property in good repair. Also want to report their finances on a pretty regular basis. The lender may also want some escrow accounts, and those escrow accounts can be for insurance premiums and property taxes. Those are the 2 most common that you see almost all the time. There might be an escrow account for repairs. This is especially true in apartment complexes, that the lender wants the borrower to every month fund some money in an escrow account for repairs so they can replace the roofs when the roofs need to be repaired, so they can put up new siding on the units when it needs new siding, or they can fix the parking lot when it needs to be repaired. Another escrow account, especially in shopping centers, is for tenant improvements and for leasing commissions. The landlord, when the landlord leases to a new tenant, is going to have to come out of pocket to pay for some tenant improvements, depending upon where you are in negotiation strength. You're going to have to pay some leasing commissions to the brokers who brought that tenant in. And the lenders want the borrowers to have a pot of money sitting there on the side to be able to pay for those tenant improvements and pay for those leasing commissions, because they want that new lease to get signed so that the rental income stream starts. They don't want the landlord sitting on the property because he doesn't have money in his pocket to make tenant improvements to pay the leasing commissions. Final payment on the promissory note. The lender should mark it paid or paid in full and return the original to the borrower. The companion document, the deed of trust that has the lien, you need to get rid of that somehow. But once a document is recorded in the real property records, it never goes away. It's always there. You cannot remove it from the real property records. So that instead, the lender signs a release of lien. Records, it's always going to be there. Normally, the borrower has the obligation to provide the release of lien document. Some lenders provide it and say, we got our attorney to prepare it, and borrower, you got to pay the fee for the preparation of that release of lien. And the borrower usually has the obligation to record that release of lien in the real property records. Then more than once, I've seen a title insurance come out when a property owner is getting ready to sell the property, and it shows that there's still a lien out there by some bank, but that loan was paid off 5 years ago. You start talking to the seller, and the seller says, well, I know I paid it off. They sent me a release of lien. And you say, where's the release of lien? And the guy says, well, it's right here in my file. And that's wrong. You should have taken it down to the courthouse and recorded it. It's never too late to record a release of lien, though. That's the good news. If it's personal property and you've got the UCC financing statement, it's a similar kind of thing, only it's not called a release of lien, it's called a termination statement, and it's UCC form number 3. The financing statement is UCC form number 1. But the lender files a termination statement to show that his lien on the personal property has been released. This one, a lot of people that fall in the crack because financing statements are only good for 5 years. No matter when you file a financing statement, it expires after 5 years. So if the lender has a 10-year loan, the lender files a continuation statement after 4.5 years to renew that financing statement for the next 5 years. But if you never renew it, it expires after 5 years. So the releasing the liens of the financing statements they kind of take care of themselves over time. The last thing I want to talk about is bankruptcy, our other bad thing. So the two most common types of bankruptcy that you'll come across are Chapter 7 and Chapter 11. Chapter 7 is a total liquidation of the business. Chapter 7 is a reorganization. The business is going to try to continue, but they're going to reorganize. So what happens in the bankruptcy? The first thing is an automatic stay. The second that bankruptcy petition is filed, there is an automatic stay in place that says to any creditor of the borrower, any lender, you can't do anything to the borrower for a little while. You're stayed, you're stopped from doing anything. You can't foreclose. You can't go use any kind of self-help. You can't lock them out. You can't do anything without court approval first. That's so the dust can kind of settle and we can start working through the numbers and what's going on. The purpose of bankruptcy is to take the pot of money that the borrower has, that the debtor has, and equitably apportion that between all of the creditors. Some of the creditors are going to get more, some of the creditors are going to get less, but we're going to try to do it in a fair manner. And the first thing that is done is, if you're a lender and you are partially unsecured, meaning if the value of your collateral is less than the value of your loan. So you've got a loan for $500,000 secured by a piece of property, but that piece of property is only worth $300,000. It's not worth $500,000 for whatever reason, changing market condition, or maybe the lender just made too big of a loan. Well, the debt for that lender is going to be reduced to $300,000. He is a secured creditor. He'll get the value, assuming there's that much money in the bank of the state. He'll get his $300,000, but he won't get the $500,000 because he was under collateralized. Once all the lenders with collateral are paid, then the unsecured lenders get paid with whatever's left over. And so that's why they only get pennies on the dollar or nothing. So the problems with bankruptcy is the lenders lose time and they incur costs that they're not going to get back. So the lenders very often work on the loan documents to try to make bankruptcy as remote as possible. A number of different things that they do in those documents. So that's where I'm going to stop with my presentation today. I'm going to leave about 5 minutes for questions. If any of y'all have any questions, and Amy, has anybody typed in any questions? And if you're on camera, you get to go first, so wave if you have a question. And I don't see anybody waving, so Amy, fire away.
I'm going to give people a moment to type while I address a couple of questions that have come up while you were speaking, Rick.
Okay.
I'm just going to briefly touch on the CE thing while people are hopefully typing questions, because there still seems to be some confusion about that. We would love for folks to be able to get CE in the confines of their own home while they're wearing their jammies, but you can't. If you want credit for things, if you want CE credit, you have to make arrangements beforehand. You still have to view the presentation at a proctored location, which is why we tell you to get in touch with your local board. You still have to go somewhere where someone can sign you in, sign you out. And with this system, you have to go somewhere they can sign you in, sign you out, and we can have an interaction with the system.
And I can see you on the screen.
Yes. So if you are just watching this at your desk, no, you will not be able to get CE credit. That's why when we send out the announcements for it, we say, contact your local board if you would like to receive CE credit, because they have to set it up for you. Or we can also get it set up at an office situation. That's also possible. Okay, I have a question. What's the process? Okay. Oh, somebody asks, what about SBA loans? Oh, how much time do we have?
Well, SBA loans, SBA, Small Business Administration, and the SBA doesn't make any loans. It's an SBA guaranteed loan. So you go to an SBA lender, normally a bank, and just go through that bank's loan process. It's exactly the same loan process. The bank may have to underwrite the loan and get some things from you that they might not get on a non-SBA loan, but it is a loan from the bank that the bank applies to the federal government, applies to the Small Business Association for a loan guarantee. And by virtue of that loan guarantee from the SBA, think of that, that's additional collateral for that lender. So the lender now has got a lien on the real estate, and he's got the SBA as a guarantor. Think of the SBA as being a guarantor of that loan. And so the SBA's got pretty good credit. So the lender may make you a loan with a little bit lower interest rate because you got a good guarantor. That's basically all an SBA loan is. You just got to comply with all the underwriting requirements.
Someone asks, what are the most common negotiable terms with lenders?
Well, that's tough. Everything is negotiable. Some things more negotiable than others.
Except Rick's case.
Things that don't deal with the amount of money that go to the lender are more negotiable than things that deal with the amount of money that go to the lender. Things like how much money you have to have in your escrow accounts. Escrow accounts are really negotiable, and I gave you some examples of some of the kinds of escrow accounts. But very often, especially on apartment loans, we've been able to negotiate that once the repair reserve has gotten up to a certain cap, then they don't have to contribute to that monthly anymore. And so that's a very common kind of thing to negotiate. But negotiating, first thing you negotiate is the interest rate. But once you get that set, all the other basic payment terms are pretty tough to negotiate.
I have someone who asks, what is a typical current interest rate for commercial retail property for renting? Just for high-level calculation, should I go with residential rate plus 1% or residential rate plus 6%?
Oh, plus 6 is way too high. I go with the residential rate plus 1 or maybe 2. I got a flyer, back to the credit unions. I got a flyer from a credit union here in town, here in Austin, last week. And their rates, they were touting a rate of 4 no, take that back. I think it was I think they were saying 3.75 for a 5-year loan, 4 1/4 or 4.5 for a 10-year loan, and I think it was 4.75 for a 15-year loan. But they were really hustling. I wouldn't expect to get anything lower than that, but check around. That's one good thing about using a loan. If you got a big loan, use a loan broker. They can help you find some better rates, and start thinking about some of the other lenders and strict commercial banks. You might be pleasantly surprised.
Someone says here, slightly off topic, but I'm working with some clients on a 10-year commercial lease, and the personal guarantee has been a key factor. Do you have a perspective on the current, quote-unquote, market for personal guarantees on commercial leases?
Okay. Yes, I do, as a matter of fact. And let me first say, we're right at 9 o'clock, and I'll take this question. Amy, if you want to do one more, we can do one more, but we need to let them go at some point. Commercial lease guarantees. And Texas is a big state. One thing that I've learned is what is normal in Dallas is very different from what is normal in Houston, which is very different from what is normal in San Antonio, and everything else is in between. And depends upon the strength of for the lease. Of course, it depends upon the strength of the tenant. If it's a national credit tenant, you're going to get away without a guarantee. If it's a mom and pop who have just started their yogurt store and they've never operated one before, that landlord is going to require a full guarantee, and that guarantee is probably never going to go away. But the The common kinds of negotiations are kind of what I just talked about on the loans, is try to make the guarantee go away after some number of years, or put a cap on the dollar amount of that guarantee. Sometimes it's a set dollar amount. Sometimes it's, no more than a year's worth of rent, no more than 6 months worth of rent. It all depends upon the negotiation strength and the financial strength of both the landlord and the tenant. So do one more if you want to.
I think all of the other ones would take us a little too long. So
Okay.
I'm going to advise people with unanswered questions to note Rick's email address and the number of the legal hotline here at TAR. And then we can wrap up. I want to remind everybody that our next webinar is on June 21st, and the subject is a case study of the 2015 Jennings Award winner for Outstanding Commercial Transaction. It's going to be presented by the author of that transaction, Jeff Kahn, who is an agent in Lubbock. And CE credit for that webinar is pending. And on the CE topic again, if you are confused about obtaining CE credit for these, please feel free to call here and ask for Amy or ask for John Hauser, and we will talk you through it. We'll get all of that straightened out. Again, we will put a recording of this as well as the slides that Rick used on the commercial webinar page. If you go to the business specialties area of the Texas Association of Realtors website, which is texasrealestate.com, click on commercial, then scroll down and click on commercial webinars. It will take you to a page where you will find links to slides and recordings of all our previous webinars. With that, I would once again like to express my deep gratitude to Rick Albers, our hero, for presenting us with this webinar today.
My
I'm
pleasure.
sorry we couldn't get to everybody's questions. I'm also, again, sorry for the wackiness at the beginning. I hope it will not discourage you from attending again. There will be an email going out soon with registration for our upcoming webinars. And with that, I think we can call it a day. Have a great day, everybody. Thanks for joining us.
All right.